How we doing today, guys? It's Zach from ARL back with another video. So today we'll be talking about the basics of options contracts, what are calls and puts, and basically overall what are options and how do they work, how do they get their prices. So let's dive right into the video. So like I said, today we'll be talking about options contracts overall and what are calls and puts. So we're going to dive into a few things that basically define exactly what an option is and how it gets its price. So if you don't know, options are contracts to purchase a stock at a certain price. So let's dive right into Robinhood. I'll show you guys Robinhood and Webull today. I'm not really going to be going over the options chain and the specifics of the options chain today. That's for another video. Today we're just going to be talking about overall options and how they kind of get their prices. Alright, so let's dive right into Robinhood. So here we have Apple stock, which currently is priced at $134. And you can see here that in one day it went up $2, in a week went up 82 cents, and then in the past month it's went up $12. So that's kind of showing you how Apple kind of moves, and each stock has this. You can search up any stock, whatever. And this Robinhood desktop application is going to look a little bit different than what you would normally trade on, which is your phone or your tablet or your mobile device. So it kind of converts over. You can kind of get the gist of what I'm be showing you here and what I'm explaining, but it does look a little different. So take that into account. But let's get into it. What is an option? An option is a contract that gives a buyer the opportunity to buy or sell 100 shares of stock at a certain price. So that sounds really technical. It sounds like you probably won't understand that if you're just getting into options. So the simplest definition I can give you is an option is a contract to purchase a stock at a certain price. Now, that is if you execute an option contract. 90% of the time, you're not going to execute an option contract, so that doesn't matter at all. The typical way that investors use option contracts are to profit off of a stock's movement more than just you buying a share. So if I were to buy Apple shares at $134 and it went up to $140, and let's say just this week it went up to $140, that's a $6 move. Now, if I bought shares, okay, I made $6 per share. But if I bought options, I can make hundreds or thousands of dollars off of that single move from Apple stock, which is very beneficial. That's why a lot of investors use it. If you know what you're doing, it can work well for you, but it can also go against you. So that's where we'll get into what is a call and what is a put. A call is an option contract that benefits when the stock increases in price, and a put is an option contract that benefits when the stock decreases in price. So if you think Apple stock is going to go up, you should buy a call. If you think it's going to go down, you should buy a put. But there's plenty of things that go into an option contract that make it way more complicated than just simply, oh, I think it's going to go up, let me buy a call. Oh, I think it's going to go down, let me buy a put. So let's get into all of the complicated things. Are a little bit complicated, but once you understand them, they're very easy. But there's pretty much three main things that option contracts entail that you should understand before you buy or sell options. All right, let's get into what makes an option move, what makes the options prices move, what is important to an option. So the first is expiration date. Every option contract will have an expiration date. And as you can see here, you can get an option expiring this week. You can get an option expiring all the way out in 2023. So you can buy options far out close to the date that the current date. You can get whatever you like. But each one of these comes at different prices. So with the expiration date, you have to understand options are always fighting against time. So as each of these options, no matter what the date is, as each of them get closer towards the expiration date, they are getting closer to being worthless. So, what you must understand is these are weekly. These contracts right here would be considered weekly contracts, and they're at this price. So the farther out you go, the higher probability that a stock would rise and get to the strike price. So the current share price is 134. If you're buying this contract right here, this strike price is 140. So you're predicting that on May 7th or by May 7th, Apple stock price would get to 140. It doesn't necessarily have to get to 140 for you to make some profit, but that's the beauty of options. If I were to buy this today at $135, then in a few days, if Apple happened to be at 138, this contract would have a higher price because people will be paying more money because Apple's probably going to get to 140 by the expiration date. So the thing with options, like I explained, is you are fighting against time, but if the stock is going in your favor, then you're going to be making profit. But it's important that you know that the farther out you buy, the less likely that the stock is going, your strike price is going to get in the money. So in the money, out the money, and at the money are three different things that you must know if you're buying options. In the money, if you're buying a call, in the money means anything below the current stock price. So Apple's at 134 right now. Any strike price below 134 is considered in the money for calls. And it's the opposite for puts, but we'll explain all of that in a second. Out the money is anything 136 or above. At the money is that 135 strike price because it's literally at the money. So 136 and any strike price above that, that's out the money. Your option is considered out the money, and when a contract is out the money, it's time decay. The amount that it's losing every day if the stock isn't going in your favor, it's hitting harder and harder as it gets closer towards expiration. So that's what you're fighting against when you're playing options. Now you can use that in your favor. There's different strategies that you can use time in your favor, but we're not getting into that today. You can watch another video for that. But the next most important thing for options is the strike price. So the strike price, like I was saying, it's any of these right here are your strike prices. So when you're going to look to buy an option contract, you're going to want to look at these prices because technically when you're buying this, you're saying, okay, if I want to buy this 142 contract, I think Apple is going to reach the price of 142 by May 7th. So that's saying I think Apple's going to rise $8 in 2 weeks, and this contract will get in the money or close to the money. Now, like I was saying, this contract does not have to get in the money for you to be profitable if you were to buy it today. But that's the thing with options. You can buy way ahead. Drastic moves can happen. If you buy way ahead and now all of a sudden there's a lot more demand for your contract because the stock is getting closer to where your contract is, then you're going to make profit. But if the stock is moving against you or it's not moving at all, your contracts are going to just decrease and decrease and decrease every day as it gets closer to expiration. You don't want that. You want it to be going your way, or you want to be playing an option strategy that works in your favor. So the third most important thing for options is volatility. Volatility is the measure of risk for an investor. So for Apple, it doesn't have a very high volatility because the stock isn't going to move $15 in a day. It's not just that. Those drastic moves don't regularly happen with a stock like Apple. So its volatility is pretty low. So that's why you can get these contracts $6 out the money 2 weeks out at $135. So if you don't understand the prices of these option contracts, it says 3.2 right here, but that's $320. You have to multiply by 100 to get the actual price that you'll be paying for this contract. But like I was saying, Apple is in a very volatile stock, so these contracts are pretty cheap. But if you go farther and farther out, these will get more expensive because you're paying for more time, and with more time is like it's more insurance. So I have to pay to be able to buy these contracts out here. Even when it gets farther out the money, it's still a little bit expensive. That's a $40 move in a few months. So 4 months, a $40 move. It's not likely, but anything's possible. But a drastic move is not usually likely, and most people can't really predict a drastic move. So you're paying for time when you get really out here with these later dates and these farther strike prices. So with a stock, let's say like Tesla, you're gonna have very expensive options because one, it's already much higher priced than that Apple stock was, and two, these with Tesla, the stock moves drastically. Like, let's check out with Tesla. It moved $9 on one day, moved $10 last week, which wasn't much of a movement at all. But in 1 month, it moved $75. So $75 is pretty drastic for a stock in 1 month. And you're looking at these contracts, the $2,000 for a contract out here. Now, every stock that is priced at $700 isn't going to have $2,000 contracts. But Tesla is a very volatile stock. It has a lot of volume, and it can move drastically at any time off of any news. So these contracts are correctly priced right here. Whoever is giving these contracts out, they have to measure the risk that they're giving to these investors. So whoever's issuing this contract at $760, if Tesla was to close at $780 on April 30th, a person could execute this option contract and have the right to buy 100 shares of Tesla stock at $760, which is lower than the current price because they got this option contract. That's why options can be so valuable, because it's giving people the right to buy 100 shares at a certain price, which you can't do otherwise. So those are the three main things that really are important to an options prices and important to the movement of how options work, and basically what calls and puts are. If you guys have any questions, you can ask in the Discord. But thank you guys for watching, and see you on the next one.